What's up, traders? In today's video, we're diving into one of the most useful concepts in CRT-based price action, the candle 2 closure. This is a setup that can help you identify potential reversals early while also giving you a framework for anticipating continuation moves afterward. Inside that model, there are two primary closure types I focus on, candle 2 closures and candle 3 closures. In this lesson, we're going to focus entirely on candle 2, and how it can completely change the way you read market structure. Before we get into the actual setup, you first need to understand the difference between a continuation closure and a reversal closure. This part is critical because most traders confuse the two and end up entering in the wrong direction. So let's start with a bearish market example where price is already trending lower. And the question becomes simple here. Is price likely to continue moving down, or is the market going to reverse? Here's what continuation looks like. Price pushes below the previous candle's low, takes liquidity from that level, and then closes below it. That close below the previous low indicates bearishness and suggests the market is likely to continue lower. In other words, the sweep confirmed continuation lower. Now let's compare that to a reversal closure. In this situation, price again sweeps below the previous candle's low, but instead of closing underneath it, the market rejects that move and closes back inside the previous candle's range. That rejection is important because it shows that the market tends to reverse after taking sell-side liquidity. When that happens, we are good to go higher and target the opposing liquidity. And this is exactly where the candle 2 closure becomes powerful. The entire idea behind this setup is identifying when price takes liquidity above or below a candle and then closes within the previous candle's range. That indication is what creates the reversal pattern. So let's break it down visually. In a bullish example, price sweeps below the previous candle's low and then closes back above that level. That tells us smart money stepped in aggressively and rejected lower prices. This becomes our candle 2 reversal closure. In a bearish scenario, the opposite happens. Price runs above the previous candle's high, grabs liquidity, and then closes back below the high. That rejection signals potential downside reversal. But here's the part most traders miss. This pattern should never be traded in isolation. If you try to take every single liquidity sweep with a close back inside the range, your results will be extremely inconsistent. Context matters. You need higher time frame alignment and a clear point of interest supporting the setup. Personally, I like using fair value gaps, external highs and lows, and major liquidity zones to build that bias. Once the candle 2 closure forms, our attention shifts to candle 3. After the market reclaims the range, we want to see expansion in the intended direction. So in a bullish setup, we expect candle 3 to continue higher. In a bearish setup, we want candle 3 expanding lower. This continuation helps confirm that the reversal on candle 2 was valid. Now here's where things become even more interesting. Let's say candle 3 closes strongly outside candle 2's range. Is that another reversal signal? No. That becomes a continuation closure, but only if the buy-side liquidity is still intact. The market is now showing acceptance in the new direction, which increases the probability of expansion into candle 4. So in a bullish example, candle 3 closes above candle 2's high with strong momentum. That strength allows candle 4 to continue expanding higher. In the bearish example, candle 3 closes below candle 2's low, confirming downside continuation and creating room for candle 4 to extend lower as well. This sequence is what completes the candle 2 closure model and forms a clean swing point in the market. So let's quickly summarize the entire process. In a bullish setup, candle 2 sweeps below candle 1's low and closes back above it. Candle 3 then delivers a strong continuation close above candle 2's high, and candle 4 continues the expansion. In a bearish setup, candle 2 sweeps above candle 1's high and closes back below it. Candle 3 confirms the move with a strong bearish close beneath candle 2's low, followed by candle 4 continuing lower. Again, none of this should be separated from higher time frame context. The best setups happen around important key levels, fair value gaps, premium and discount zones, or major liquidity targets. Without that context, the setup loses a lot of its edge. Now, if we combine this idea with equilibrium concepts, we can refine the model even further. For example, when candle 2 forms with a large wick, I want to pay attention to the upper half of that wick in bullish scenarios. Then I watch how candle 3 reacts around that 50% level. If price respects equilibrium and continues higher, the setup remains strong. But if the market fails to hold that midpoint, the reversal becomes much less reliable, and the swing point may completely fail. We can apply the same logic to candle 3 after it closes strongly. Mark out the entire range of the candle, identify the equilibrium level, and use that as a reference point for continuation. This helps create more precise entries and better trade management overall. If you're not familiar with equilibrium, wicks, or fair value gaps yet, I highly recommend studying those concepts alongside this model because they work extremely well together. Now that you understand the theory, let's jump into TradingView and walk through a few real chart examples so you can see exactly how candle 2 closures form in live market conditions. All right, we're on the charts now, and the best way to truly master candle 2 closures is through chart practice and repetition. The more charts you study, the faster your pattern recognition becomes. So, we're already inside TradingView. Let's mark up some annotations and break these setups down step by step. As you can see, we already have a few swing points mapped out on the chart. Let's start from here. Right here, we have a clear swing point, and our key level, or point of interest, is this fair value gap. Once price tapped into that area, we can see a clean candle 2 closure. Because of that confirmation, we could be anticipating candle 3 and even candle 4 to continue delivering downside movement. Now, if we move toward the next swing setup, this becomes another strong example. Again, we have a fair value gap acting as our point of interest, and the moment we receive the C2 candle closure, we could anticipate candle 3 moving lower once again. Moving further, we get another swing point. In this case, we're using the opposing candles as the point of interest. As soon as the candle 2 closure formed, we had confirmation to anticipate higher prices through candle 3. Now look at this setup here. Once again, we have a candle 2 closure, and our key level is another fair value gap. But this setup is slightly different. Although we did receive the closure, we don't really have a strong or fresh point of interest supporting the trade. Yes, technically there is a fair value gap sitting in the background, but that imbalance has already been retested multiple times. And personally, I don't like taking setups from heavily retested zones because the reaction becomes weaker over time. So this is the type of setup I would avoid. Now moving to the next example, here our point of interest is an old high. However, even though the level itself is valid, but we didn't see any candle 2 closure confirmation. Because of that, this is another setup I would avoid. Now let's continue. Right here, once again, we have a fair value gap acting as the key level, and once we receive the C2 closure, we could anticipate candle 3 expanding toward higher prices. Then over here, we have another old high acting as our point of interest. We received the C2 closure again, which gave us confirmation to anticipate downside movement through candle 3. Now the most recent here, we received another candle 2 closure setup, and this time we actually have multiple confluences supporting the trade. We have the old low acting as a key level, while at the same time we also have a fair value gap sitting inside the same area. So once we receive the candle 2 closure, we could anticipate candle 3 moving toward higher prices. And notice this carefully. Once candle 3 closed with momentum above the candle 2, then we could anticipate candle 4 continuing toward even higher prices. Alright, so let's break down the most recent example and talk about how you can actually trade candle 3 after getting a candle 2 closure confirmation. So if we look at this setup carefully, our point of interest here is a fair value gap. We received a clean candle 2 closure, and above we have some nice failure swing highs resting as liquidity. Now, if I want to trade candle 3, what I usually do is confirm the wick of candle 3 by marking out the upper half of candle 2. So, let's mark it out. Right here, we have buy-side liquidity resting above these highs, and if I want to trade candle 3, I'll use the upper half area of candle 2 to confirm the low before targeting the buy-side liquidity. Since this is the daily time frame, let's align ourselves with the lower time frame and move down to the 1-hour chart. Alright, now we're on the aligned time frame. The first thing I want to do here is mark out the new day open, which in this case is the 1800 hour. So the new day open begins from this point right here. Now, after receiving the candle 2 closure, notice what happens next. We can see a clear change in the state of delivery. So let's mark that out as well. And right here, this becomes our upper half area of candle 2. From this zone, we can begin looking for our position entry. The stop loss would be placed below the low, while the target can either be the 2R objective, or we can simply target the buy-side liquidity resting above those highs. Now let's replay the market and see exactly how this setup played out. Alright, and there it is. You can see price tapping directly into our level and then delivering the move perfectly into the target. Alright, so that's going to wrap up today's lesson. Hopefully now you understand how to identify candle 2 closures, how to frame candle 3 executions, and most importantly, how to align them with key points of interest for higher probability setups. Remember, the goal is not to force trades. The goal is to wait patiently for clean confirmations and let the market come to your levels. That's where consistency starts to build. If you found value in this video, make sure to leave a like, drop a comment with your biggest takeaway, and share this video with another trader who's serious about improving. And if you're new here, subscribe to the channel because we're going much deeper into candle range theory, SMT, PSPs, and execution models in the upcoming lessons. Thank you for watching, and I'll see you guys in the next one.